Ever wondered why candlestick patterns look the way they do? What's the psychology behind these formations? Welcome, trading enthusiasts. We're about to embark on an illuminating journey into the art of trading candlesticks. Candlestick patterns are more than just pretty shapes on a chart. Each form tells a story of market sentiment, painting a picture of the battle between bulls and bears. They're the language of the market, and understanding them is crucial for successful trading. In this video, we'll dissect each candlestick pattern one by one. From the engulfing bar to the doji, from the dragonfly doji to the gravestone, and all the way to the harami and the tweezers. We'll uncover the secrets they hold and learn how to read their signals. So buckle up, because we're about to turn the lights on the shadowy world of trading candlesticks. Ready to decode the mystery of candlesticks? Let's dive in. Candlesticks, they're not just for romantic dinners, they're the foundation of financial charts. Now don't get confused. We're not talking about wax and wicks here, although the concept is surprisingly similar. Candlesticks in trading are a graphical representation of price movements in a set time period. Each candlestick represents four key pieces of information: the opening price, the closing price, the highest price, and the lowest price during that period. Picture it as a rectangular box with two lines sticking out. Kind of like a candle, right? Let's break it down further. The rectangular part of the candlestick is called the body, and those lines sticking out? We call them wicks or shadows. The top of the body represents the opening price and the bottom represents the closing price for a bearish candlestick. Flip it around for a bullish one where the opening price is at the bottom and the closing price is at the top. The wicks then represent the highest and lowest prices reached during that time period. Now, on to the big question. What's the difference between bullish and bearish candlesticks? Well, a bullish candlestick is when the closing price is higher than the opening price. Think of a charging bull, moving upwards. The body of the candlestick is usually filled in or colored to indicate this upward movement. On the other hand, a bearish candlestick is when the closing price is lower than the opening price. It's like a hibernating bear, moving downwards. The body of this candlestick is often left blank or colored differently to distinguish it from its bullish counterpart. So, in the flicker of a candlestick, we can see the tug-of-war between buyers and sellers, the struggle between hope and fear, the balance of supply and demand. It's a story of price, told in a simple visual way. Now that we've lit the candle, let's move on to the various types of candlestick patterns. Ever heard of the engulfing bar and the doji? They're more than just fancy names. They are key candlestick patterns that can help you understand market trends and sentiment. First, let's talk about the engulfing bar. It's a pattern that forms when a candle, either bullish or bearish, completely engulfs the previous candle. It's like a big fish swallowing a smaller one. This pattern often signals a potential reversal in the market, as it reflects a strong shift in buyer or seller sentiment. Now, on to the doji. The doji is a unique candlestick pattern where the opening and closing prices are virtually the same. It's like a perfect balance of power, with neither the bulls nor the bears gaining an upper hand. This pattern often signifies indecision in the market and could indicate a potential change in the current trend. Remember, the engulfing bar and doji aren't just patterns, they're signals. Signals that can guide your trading decisions. Dragons and gravestones sounds like a fantasy novel, doesn't it? But in the world of trading, they're key candlestick patterns. Let's dive into the dragonfly doji and the gravestone doji patterns. The dragonfly doji, as fierce as its namesake, forms when the open, close, and high prices are virtually the same with a long, lower shadow. This suggests that the market after opening was dominated by sellers, but the buyers fought back to close at the opening price. A clear signal of a bullish reversal. On the other hand, we have the gravestone doji. Chilling, isn't it? This pattern occurs when the open, close, and low prices are nearly identical with a long upper shadow. It indicates that buyers controlled the market after opening, but by closing time, the sellers had taken over, signaling a potential bearish reversal. Learning these patterns is like learning a new language, the language of trading. Morning star and evening star, no, we're not talking about celestial bodies, but crucial candlestick patterns. Let's dive into these two illuminating patterns. The morning star is a bullish pattern that appears at the end of a downward trend, signaling a potential reversal. It's made up of three candles: a long bearish candle, a short candle, and a long bullish candle. Now let's switch gears to the evening star, the polar opposite of the morning star. It's a bearish pattern that appears at the end of an upward trend, hinting at a possible downtrend. This pattern also consists of three candles: A long bullish candle, a short candle, and a long bearish candle. But what's the psychology behind these patterns? Well, they represent a change in market sentiment. The morning star signifies the bulls regaining control, while the evening star suggests the bears are taking over. Remember, the morning star and evening star can be your guiding lights in the dark world of trading. Hammer, shooting star, harami, and tweezers. Sounds like a list of random objects, doesn't it? But in trading, they're key candlestick patterns. First up, the hammer. It's a bullish pattern that appears during a downtrend. The lower shadow is twice the length of the real body, giving it the appearance of a hammer. This pattern suggests that even though sellers were able to push the price down, buyers fought back and drove the price up again. It's like a glimmer of hope during a gloomy day in the market. Next, let's discuss the shooting star. It's the mirror image of the hammer and appears during an uptrend. The higher shadow is twice the length of the real body, resembling a shooting star. This indicates that buyers pushed the price up, but the sellers swooped in and drove the price back down. It's essentially a warning sign that the uptrend may soon reverse. On to the harami pattern. Harami means pregnant in Japanese, which is an apt description for this pattern. It consists of two candlesticks. The first is a large candle, and the second is a smaller candle that fits within the range of the first. It's like the market taking a breather after a significant price move, signaling that a reversal may be on the horizon. Finally, we have the tweezers pattern. This consists of two candlesticks with matching highs or lows. Imagine holding a pair of tweezers, pinching and pulling at the price. This pattern indicates a potential turning point and is particularly effective when combined with other indicators. So, why do these patterns form? Well, they reflect the tug-of-war between buyers and sellers, the constant push and pull in the market. Recognizing these patterns can provide insight into market sentiment and potential price reversals. It's like being able to read the mind of the market. These patterns are your tools. Use them wisely. So, what have we learned today? Quite a lot, I'd say. We've embarked on a journey through the world of trading candlesticks, discovering the art and psychology behind their formation. We've peeled back the layers of the market's ever-changing moods, finding clues in the shadows of each candlestick. We started with the basics, understanding the anatomy of candlesticks, their bodies, and their wicks. We learned how these simple shapes can reveal the open, high, low, and closing prices of a trading period. Then, we dove into the world of specific candlestick patterns. We saw how the engulfing bar pattern can signal a potential reversal in the market, while the doji candlestick pattern emphasizes market indecision. We discovered the dragonfly doji and the gravestone doji, two patterns that reveal the battle between buyers and sellers in the market. We greeted the morning star and bid farewell to the evening star, two powerful three-candle patterns that can predict a change in market direction. We hammered home the importance of the hammer candlestick pattern and shot for the stars with the shooting star pattern, both key indicators of potential market reversals. We explored the harami pattern, a pregnant pattern that could hint at a future reversal. And finally, we got a grip on the tweezers tops and bottoms, a pattern that could indicate a potential turning point in the market. Each of these patterns is a piece of the trading puzzle, a snapshot of market sentiment at a given moment. They are the language of the market, and by learning to read them, we can start to predict future market movements with greater accuracy. But remember, no pattern is absolute. They're simply tools to help us make more informed trading decisions. It's always important to consider other factors like volume, trend, and technical indicators when making your trading decisions. Candlestick patterns are not just formations, they're a story of market sentiment, of fear and greed. Learn to read them and you'll be one step closer to mastering the art of trading.